Hello guys, welcome to another video. So today, if you're watching this video, you'll be catching up whether or not there will be a major adjustment happening in the stock market. Because when you're seeing this video, last Friday, we called it a Black Friday because all the indices in the United States will be adjusting a lot. So people now are pretty worried about whether or not the stock market will be having a bigger adjustment or even going into a recession. So with that being said, remember to check out my last video. I talked about one signal, one solid and 100% accurate signal that we can determine whether or not it's a recession, right? So right now, long story short, because I assume that you have watched this video, we will say that this is not a recession. But even though there's maybe a big adjustment happening in S&P, for example, 1,000 points is pretty much insane. So we have to understand the valuation of the stock market right now. So after that, last Monday, almost all the stock indices all around Asia and Asia Pacific are all adjusting pretty much heavily in the last week. So right now, we'll look at one problem is that by looking at the S&P 500 index, you will for sure, with your own naked eyes, you will say that it's really expensive, right? Because in 1 year, it went from 2,000 points to almost 3,000 points. It's pretty insane. So we think that is really expensive, right? So now we'll check out this problem. So one of the signals we talk about is looking at the price to earning ratio of this index. For example, after all the crises that we have experienced before, the highest P is in year 2000, which is the tech bubble, right? The highest P is around 29.3 times the P ratio. So this is the highest. Again, I mentioned about that because we were experiencing the tech bubble. Some of the companies and the blue chips, they not even have earning. So the P ratio is infinite, right? So that is really high, we can explain that. But the lowest P ratio that it could create a bubble is last time. It's the subprime mortgage crisis, which happened in 2007. The P ratio is around 18 times. So the average P ratio for the bubble to burst is around 22.24 times P ratio. So right now, the P ratio is around 22.4. First of all, if you understand this ratio, throughout last year, 2017, you will not worry that much. You will just enjoy your ride and until it hits maybe 20 times, 21 times, right? So the other question is, what about now? It's now 22.4, right? It's pretty much scary. Last year, we have predicted the growth of the S&P 500 and globally, actually. So for the S&P 500, we predicted a growth of 19.98% growth. So the actual number right now is 19.42. So first of all, again, last year the growth of the stock market was calculated. It's not a guessing game, it's not estimate, it's something that you can calculate, right? So it is really accurate, so it's really close. The second point, the actual number is only a little bit lower than what we expect, right? So if we can calculate the uptrend last year, there's the downtrend happening this year, we could also calculate, right? So this is what we're doing right now. It's all about the valuation, which means all the companies, the growth, the EPS, the earning growth, that is the solid, the roots of the stock market. It's not about the cash flow, not about the speculation, stuff like that. They're all BS, okay? It's about valuation. If the stock market without valuation, why you and I are investing in this stock market, right? So with that being said, right now around 231 stocks had announced their report already. So right now we will look at bigger companies like Google, Apple, Microsoft, Amazon, Facebook, companies like that. So with that being said, if we calculate their growth and every single of them has a weighting to S&P 500 index, right? So we can calculate the points that S&P 500 has actually earned. Okay, it's not speculated. It's actually the index can earn after all these earning reports have announced. So with the extreme values being eliminated, for example, 10 times earning growth, right? We exclude those. So as of February 5th, the solid points added to this index will be around 525 points, okay? So with a starting point of last year, March 31st, which is the date that all the earning reports had all been announced, okay? That is a true value, right? From that point on to the peak almost 2,900 level, right? To the peak, the growth is 510 points, okay? You understand what I'm trying to do? 510 points versus the actual 525 points. So the peak is fairly valued, okay? So we talk about last year growth is pretty much expensive, insane, right? It's not. It's all being legitimately earned, okay? So the main question is whether or not last year, March 31st, the valuation is high or low, right? You understand? So at that point, nobody is saying that the US stock market is expensive. Everyone says that the stock market is expensive because of last year, the ride, okay, is 500 points. And I'm telling you, the 500 points is almost solid, right? Even more. So the problem remains in how many of the stocks, of the companies, haven't announced their earning reports, right? In S&P 500 index, they're left with almost around 30% of the stocks haven't announced their earning reports, all right? So, for example, Walmart, which you understand that I really hate investing in this company, but they have been doing all they can to put it online. So I believe the earning report's not that bad this year. And Oracle, which still a unicorn, and also my unicorn, the Home Depot, which I've been investing in this stock for the past 6 to 7 years. So they're all announcing their reports in mid-February to late February. We have to be careful of the earning reports. Let's say they are not hitting 20% growth. They're only hitting 19% growth, right? So we have to understand the dates of the earning reports and also the growth of their earnings, whether or not they satisfy 90% in average, okay? So if they are doing so, assume they can do 90%. So the fair valuation added from last year will be 2,900 points, okay? But again, I'll talk about now, there are 3 steps for the stock to adjust, okay? The first one is economy recession. I talked about that in the last video. I really urge you guys to look at that video. If that's legit to you, please share this video to all of them, okay? People keep misunderstanding and such a big, stupid misconception happening in our brains, okay? So that's the first one, is a no, not a recession. The second one is valuation, which I'm talking about in this video. And the third one I won't talk about in this video, which would also happen, is the fear, okay? It's only because you guys will do your calculation, will look at my videos, will keep on watching my videos, so I can do the calculation for you guys. Either way, you're doing calculations. But without that, most of them are using their eyeballs to determine the valuation, right? So with this uptrend, they will use all the reasons they can to take profit. Okay, so I remind you guys again, in the past video I talked about how crucial March is, because many big events will be happening in March. If there's one time you can take profit without rationale, it's February, right? So I would say that it's not a recession, so if it adjusts for 1,000 points even, they will hit the historic high again, okay? But because of the valuation, whether or not it would hit a big adjustment, I don't think it would. But we have to be careful in the short to mid term. People will find all the reasons they can to short the index, to sell the portfolios, to sell the stocks. But that is the chance you can buy your stocks around February and around March. That is the point, because we always forget when the stock market is tumbling, we all panic. The only feeling left inside is panic. But we always forgot to prepare to buy again. And the cycle repeats because we forgot to buy and then we chase, okay? We look at the price and go up, we chase, and then it's the peak, and then we lost again, and then repeat, okay? That is a really bad vicious cycle. We can all break it right now, and the tool is calculation and rationale. So hopefully this video will help you guys. Please remember to give me a thumbs up and also share this video to your friends, especially your friends just maybe you know that they just speculate without legit reasons, okay? They just speculate with their own knowledge. We would never born with investment knowledge. We'll always acquire and learn it, okay? So hopefully this channel will help you guys, because my theory, my mission is investing made easy. So remember, give it a thumbs up, share this video to your friends, and leave a comment so we can interact. I'll see you next time. Goodbye.